And now we're going to talk about why, this is lecture 3 from chapter 1, CFIN7. We're going to talk about why the corporation results in value maximization. So the first is limited liability. So limited liability reduces risk, which increases the market value of the firm. So because investors can invest without, all they're risking is the dollar value of their investment. If there was additional risk associated with that, then they would expect a higher return and would be more reluctant to invest. Now, ease of raising capital allows corporations to take advantage of growth opportunities. So invest in projects that will increase the value of the firm. We'll talk about this more as we talk about dividend policy. Ownership's easily transferred. So we can, with publicly listed or traded corporation, we can literally go on our computer and buy as many shares as we have the wherewithal to buy. We can also sell those shares, and it takes literally a matter of seconds, if even seconds, for that transaction to take place. We enter that transaction, and if it's a market order, it takes place virtually immediately. Now, so, as a result, investors are willing to pay more for a corporation. So this is what we're talking about here is liquidity. The fact that a stock is a liquid asset. Things like bonds are much less liquid asset. So there's a much greater bid-ask spread on a corporate bond than there is on a stock. Goals of the corporation. The primary goal of the corporation, stockholder wealth maximization, or maximizing the firm's share price. At one time, it was thought that this should be done at all costs. That has sort of changed to some extent. Then we have to use managerial incentives to align the goals of the corporate management with those of the shareholders. So this usually comes in the form of stock and stock options, so forth. It can also be things like warrants and so forth. But the idea is to give the manager some skin in the game. We want the manager to benefit when the company does well. This is also why you see at least some of the incredible or very large compensation numbers that corporate executives receive. It's not that their salaries are low, but the vast majority of their compensation comes when the company does well. Social responsibility. This is a relatively new issue. Interestingly, there's evidence that socially responsible companies perform better than those that are not socially responsible. But many corporations still look at this as a cost or an expense. But there's evidence that it's not necessarily a cost. The managerial actions with regard to maximization of stockholder wealth. Managers make capital structure decisions. So when we're just making a capital structure decision, we're generally deciding in the United States, we're deciding between whether to issue stock or issue bonds. The younger corporations will have less access to the debt market and be more reliant on equity. Older, more seasoned corporations will have much greater access to the debt markets. Debt is generally cheaper. As long as the company is not in financial trouble, because the interest payments on debt are tax deductible. The one thing about debt in the U.S., that for the most part we are talking about the bond markets, and that is because the regulatory environment with regard to banks in the United States actually raises their cost of capital to a level higher than a comparable corporation. So it makes it detrimental to borrowing from a bank. So for the most part, that's why you see corporations going to the bond market. There are some exceptions, but if they have a choice, they will likely go to the bond market because the regulatory environment has created a situation where it is much cheaper to go to the bond market. So, capital budgeting decisions. So, what assets or investments should the firm purchase? So this is important, because you don't want to invest in an asset that reduces the value of the firm, and this can occur if the rate of return on that investment is lower than the firm's cost of capital. So the firm's cost of capital is the minimum level that is acceptable, because investing at the cost of capital means that you're maintaining the value of the firm. Anything less than that would reduce the value of the firm. Dividend policy decisions. How much of the firm's income should be distributed to stockholders and how much should be retained. A lot of times like in younger companies, as they become they become profitable, there's pressure to start paying out dividends, and that actually this comes from the shareholders, but it's likely in a lot of cases that it is actually reducing the value of the firm, because the firm likely has, as a young company, likely has investment prospects that would increase the value even more. So, all right, so we will start lecture 4 with the value of the firm.